Well, assalamu alaikum friends. So for the current liabilities, the disclosure, the presentation on the statement of financial position has to be made in the order of liquidity. So in Pakistan, we usually use the British style, which means that current liabilities are mentioned in the uh, order of least liquid to more liquid. But usually in the current liabilities, it's very difficult to actually fix the liquidity. So at least for the academic purpose, you should not worry about it. What you should do is that the current maturity of the long-term liabilities, right? This is something that you should be aware of from your earlier accounting background. That the long-term liabilities sometimes they have to be paid in installments. So the installments which are becoming due in next 1 year, these are the current maturity of long-term liabilities. So they have to be shown in the current liabilities. So they should be shown first, and then the remaining current liabilities, for example, the notes payable and the unearned revenues and taxes payable and salaries and wages payable and accounts payable, etc., etc. So that's it. And now coming on to the uh, uh, analysis. So two important analysis items are the this one, the working capital and the current ratio. So the working capital actually is the difference between the current assets and the current liabilities. Why we work out this number is that its sign, whether it's a positive number or a zero or a negative number, actually identifies uh, the financial liquidity the ability of the organization to meet its liabilities as they are becoming due and to meet its day-to-day operational expenses. So because eventually the current liabilities have to be paid off from the current assets. So they will initially be paid out of the cash, the bank, and then eventually the current assets will turn into cash or will bring more cash. And then out of that, we actually will pay the current liabilities. We will not pay current liabilities by selling our long-term assets, non-current assets, right? So this is the concept behind this calculation, that current assets usually should be more than the current liabilities, and this working capital should be positive, right? If it's not positive, then the company, the organization may be in problems until and unless the organization have very sound history and forecast for future cash flows, future positive cash flows. The current ratio is actually the ratio of these two numbers, the current ratio asset upon current liabilities. And again, being a ratio, it should be more than one. So if it's more than one, again, it signifies that the current assets are more than current liabilities, right? Whereas if it is less than one, it means current liabilities are more than current assets. So the orthodox standard for the current ratio was it should be 2:1, right? But nowadays it's very rare that you see current ratio of 2:1. It's supposed to be a very high ratio, and a very high ratio is also not desirable. Why it's not desirable? Because too many current assets with fewer current liabilities means your assets are not earning, because current assets usually do not earn. The bank balance, the account receivable, the inventory, they if they are kept for say 6 months, they are kept for 6 months, right? So there is no earning on them. But when the same current assets are non-current assets, they actually earn. Why they earn? Because either these are non-current investments, or these are fixed deposits, or these are property, plant, and equipment, which actually makes revenue for makes production and the goods that you can sell it. So that's why 2:1 is now it is not considered a good ratio, but the current ratio should be somewhere above one and somewhere around 1.5 or so. But you can see different authors and different industry perspectives differently. So for example, in the retail industry, you will see relatively a higher liquidity position because they have more cash, but on the other hand, they have more current liabilities as well. So it also depends on industry to industry. Just think of yourself, what if current ratio is zero? When current ratio will become indefinite, not indefinite, mathematically undefined? What will be the situation when the current ratio will be undefined? What will be the situation when the current ratio will be negative? Can it be negative or no? Okay.